You really think you're following Warren Buffett's strategy? Truth is, 95% of people who say they invest like Buffett are actually doing the complete opposite. And that's exactly why they lose to the market every single year. In the next few minutes, I'll break down the simple detail that makes Buffett's approach unbeatable even today, and how you can apply it, even if you have just a few bucks to invest. Imagine this. Back in 1977, if you had bought just 1,000 shares of Berkshire Hathaway and done absolutely nothing, no fancy degree, no endless trading, no stress, you'd be sitting on about $80 million today. That single quiet decision would have outperformed decades of late nights, frantic market moves, and overpriced financial courses. It sounds unfair, doesn't it? How can a man who spends half his day reading newspapers and drinking cherry Coke keep beating millions of smart investors armed with apps, alerts, and MBA jargon? Most people think they know Warren Buffett's secret: buy good companies and wait. But that's not really it. There's a deeper, uncomfortable truth behind why his strategy still crushes yours, and why you'll likely ignore it the moment this video ends. But before I show you, there's one story you need to hear. And it starts with a forgotten textile mill and a very angry young Buffett. Every spring, thousands make their way to a quiet city in Nebraska. They don't go for the sights, the food, or the nightlife. They go to listen to an old man read notes and answer questions. Some call it a pilgrimage. Others laugh at the idea of worshiping a man in a cheap suit. But if you look closely, it's not the oracle they're really chasing. It's certainty in a world that punishes the impatient. Meet Mike. He's 35, works a steady job, scans Reddit threads on investing during lunch breaks, and dreams of a day he won't have to trade hours for dollars. He's read Buffett's letters, quotes him at parties, and nods wisely when people mention buy and hold. But his account balance tells a different story. Last year alone, he jumped in and out of Tesla, crypto, and some biotech play his cousin recommended. He made a little, lost more, and convinced himself he just needed better stock picks. He doesn't know it yet, but every year he does this, Buffett wins again, and Mike gets poorer, even when he thinks he's winning. There's a single flaw in Mike's understanding of Buffett's wisdom. But I'll hold that for a moment. First, you need to see where the real Buffett began, and the anger that started it all. Long before the Oracle of Omaha became a headline for CNBC, he was just a young man collecting scraps nobody else wanted. In his early 30s, Buffett prowled old balance sheets, hunting for what he called cigar butts, dying companies so cheap you could squeeze one last puff of profit before tossing them aside. One of those neglected businesses was a fading textile mill called Berkshire Hathaway. He saw quick money in its undervalued stock. He didn't see an empire. Not yet. But then betrayal fueled his next move. When the owner tried to cheat Buffett out of a promised buyback price by shaving off $0.125 per share, Buffett didn't back down. Instead, he did something reckless. He bought more. Out of spite, he took control of a dying textile company that ate cash faster than it made cloth. Rationally, it was a mistake, but hidden inside that mistake was a seed. Most investors would have dumped the headache and moved on. Buffett turned it into the holding company that would swallow Coca-Cola, railroads, banks, and Apple itself. This anger-fueled pivot taught him something Mike still hasn't grasped. It's not just about finding cheap scraps. Anyone with Google Finance can do that. The power is in transforming scraps into machines that print money for decades. But there's one part missing from this puzzle. And it's the reason Buffett's calm patience crushes every flashy trader Mike tries to be. Stay with me. We're about to hit the nerve that separates Buffett's fortune from everyone else's frustration. Every investor loves to brag about how smart they are. Fancy degrees, certifications, hours glued to screens dissecting charts. Buffett once joked, "If you have a 160 IQ, sell 30 points to someone else. You don't need it in investing." It sounds like humility, but it's really a brutal truth. The gap between Buffett and Mike isn't intelligence, it's temperament. Mike wakes up, checks pre-market futures, skims headlines, panics at every dip. If Tesla drops 3%, he sells. If crypto jumps overnight, he buys in half asleep. He calls this staying informed, staying nimble. But it's exactly this restless itch that drains his returns year after year. Buffett, on the other hand, reads annual reports, ignores pundits, and lets storms pass. He knows American businesses will outlive recessions, scandals, and election cycles. Most people say they understand this, yet they can't stomach it when the screen bleeds red. Here's the nerve. Buffett's greatest advantage is his boredom tolerance. He can do nothing for years and watch his wealth swell quietly. Mike can't sit still for a week. This is why compounding works for Buffett and burns out for Mike. And the moment you realize this, you see that beating Buffett at picking stocks is pointless if you lose to him in patience. But there's an even deeper shift that made Buffett unstoppable, a single choice that transformed him from a scavenger of cheap deals to the owner of unstoppable giants. Let's pull back that curtain now. In the beginning, Buffett made quick money picking up what everyone else overlooked, battered companies selling below their net cash value. It was clever, but it was small. One puff of smoke, then gone. He knew he couldn't build an empire on crumbs. The turning point came when he bought a small candy company that changed how he thought about value forever. See's Candies wasn't a dying factory. It was a brand people craved, paid extra for, and kept coming back to every holiday season. Buffett saw something no spreadsheet could show: pricing power and loyalty. He paid more than he usually would for a business, and it paid him back every single year without demanding fresh capital or constant babysitting. That's when he realized, a fair price for a wonderful business beats a bargain for a dying one. Mike, meanwhile, still chases underpriced stocks with no real moat: a cheap airline, a sketchy startup, a penny stock rumor. He mistakes low price for hidden value, then wonders why he's always stuck rebuilding his portfolio. Buffett broke that loop decades ago. He shifted his hunt from discounts to durability: Coca-Cola, American Express, and eventually, Apple. He didn't care about hype. He cared about moats wide enough to defend profits for decades. But buying great companies isn't enough either. And here's where most copycats fail. There's a trait even more crucial than picking the right stock. Without it, even the perfect pick turns to dust in your hands. We'll crack that open next. People like to picture Buffett as this flawless investor, immune to bad calls. But the truth is sharper. He's made billion-dollar blunders that would bury most portfolios. Dexter Shoes is his classic confession: a local shoemaker he bought partly with Berkshire stock, thinking American manufacturing would hold its ground. It didn't. Foreign competition crushed Dexter, and Buffett didn't just lose the cash value, he lost the compounded value of the shares he used to pay for it. He's called it his worst deal ever. More recently, he dipped into IBM, underestimated tech shifts, and quietly backed out. Even his Apple stake, now legendary, went against years of him avoiding technology because it changed too fast for his comfort zone. Buffett's genius wasn't in avoiding mistakes. It was in admitting them early and never repeating the same error twice. Meanwhile, Mike clings to every loser, praying for a rebound that rarely comes. He can't cut losses because each sale feels like admitting stupidity. Buffett cuts quick and moves capital to what works. It's simple capital discipline, but it feels brutal in practice. And yet, it's this discipline that magnifies every dollar of profit. One clean exit funds 5 better plays. Still, there's one hidden pattern in Buffett's mistakes that the headlines skip, and it's a clue to why he stays unbeatable even when wrong. It has to do with how he holds cash and why he waits when others panic. That's where we're headed next. Look through Berkshire's annual reports and one number always stands out: cash. Tens of billions, sometimes more than 100, sitting idle while headlines scream about missed opportunities. Critics say Buffett's lost his edge, that he's too slow to jump on trends. But they misunderstand what that mountain of cash really is. For Buffett, cash isn't dead weight, it's ammunition. He knows panic is inevitable. When fear drains the market, cash decides who buys the crown jewels at a discount and who stands outside, broke, watching. Back in the 1970s, when valuations soared beyond reason, Buffett shut down his partnership and returned money to investors because he couldn't find bargains worth owning. Years later, when the market bled red, he re-entered with both hands. The same pattern repeated in 2008. While banks crumbled, Buffett deployed billions into companies like Goldman Sachs on terms nobody else could negotiate. Panic made him a kingmaker. Mike, on the other hand, never holds cash. Every extra dollar burns a hole in his pocket. He jumps at the next shiny stock tip, or worse, racks up credit card debt convinced he'll catch up when his trades win big. He thinks cash is lazy, but when the storm hits, he's forced to sell his best holdings at the worst possible moment just to stay afloat. Buffett waits. When the smoke clears, he buys assets everyone else abandoned in fear. But there's an uncomfortable flip side. Holding cash tests every impatient nerve you have. It's the proof that you truly believe time works for you, not against you. Mike never learns this. Most people don't. But if you want Buffett's edge, it starts with embracing this uncomfortable weapon. Still, even cash and patience aren't enough unless you dodge the trap I'll show you next. A trap so subtle it devours more wealth than any crash ever could. Most people believe wealth demands constant motion. They check their portfolio before breakfast, chase news alerts, flip positions in and out like a casino chip. Mike prides himself on being plugged in, always tweaking, adjusting, reacting. It feels responsible, sophisticated even. But the market doesn't reward busy hands, it rewards patient capital. Buffett knows this better than anyone alive. He built an empire not by working harder on trades, but by removing himself from the noise. When he finds a business that prints cash reliably, he locks it away and lets time do what no broker or app can replicate: compound it quietly, day after day. That silent, invisible force is what transformed a man reading annual reports in Omaha into a living oracle for generations of money chasers. Mike doesn't see it. He measures success by daily green and red numbers. He thinks missing a rally is a crime. But what he misses is worse: the calm slope of compounding that could make him rich without fireworks. A distracted investor interrupts that slope every time he sells too soon or jumps to a trend. Buffett's true victory isn't that he picks perfect stocks. It's that he rarely interrupts the machine once it's running. Ask yourself which side you're on. Do you crave the thrill of acting or the quiet satisfaction of owning? You can't have both. This conflict is where most portfolios die. But before you swear off your habits tonight, know this: knowledge alone doesn't protect you. You need a practical filter, a checklist, to keep your choices honest when temptation strikes. Let's build that next. All the wisdom in the world means nothing if you can't translate it into choices when your money's on the line. Buffett's discipline works because he has guardrails that keep him from chasing illusions. He doesn't rely on gut feelings alone. He runs every potential investment through a simple but brutal checklist. It's not magic. It's common sense, sharpened by decades of mistakes. First, he asks, does this business generate predictable cash flow? If the answer depends on a new miracle product every quarter, he walks away. Mike ignores this and bets on whatever stock has the loudest headlines. Second, he checks for a moat, a clear edge that makes it painful for customers to switch or for rivals to steal market share. Coca-Cola has it. So does Apple, by turning hardware into a sticky ecosystem. If a business can't defend its profits, Buffett knows any short-term gain will melt under competition. Third, valuation matters. Buffett loves great businesses, but not at any price. He waits for moments of fear to buy them when others panic. That's where his cash reserve becomes lethal. He doesn't mind holding nothing for months if it means pouncing when the odds flip. Mike, however, confuses a falling price with a bargain, without asking if the moat and cash flow still stand. Lastly, and maybe most painfully, Buffett commits. Once he buys, he sits still, ignores rumors, and lets compounding work. This is where most fail. A checklist only works if you have the backbone to follow it when your neighbor brags about his overnight gains on some speculative bet. You can build your own version of this today. Filter every stock through cash flow, moat strength, realistic valuation, and your willingness to wait. But don't fool yourself. The real test starts the moment the market screams at you to do the opposite. There's one final piece to lock all this in place: the mindset that holds it together when the world calls you boring or slow. We'll close there. In the end, Buffett's greatest lesson has never been about stock picks. He's been handing out the same message for decades. Wealth comes to those who can resist the noise, trust the math, and endure long stretches of quiet boredom. People hear this and nod, but almost none live it. That's why Buffett's simple rules still outperform sophisticated algorithms and expensive hedge funds. Not because they're secret, but because they're too ordinary for restless minds to obey. Mike keeps hunting for the next shortcut, the next stock tip, the next big swing. He mistakes motion for mastery. Meanwhile, Buffett's fortune compounds quietly in businesses that mint cash every day, guarded by moats too deep for quick imitators to cross. He wins by default because he's willing to look foolish when everyone else is busy looking clever. There's a paradox here. The more you chase financial freedom, the more you risk sabotaging it with impatience. Buffett's final gift isn't a list of tickers, it's permission to step back, to build a strategy so boring it feels wrong, and to let time do the violence for you. You don't need to move to Omaha or read 500 pages a day, but you do need to make peace with stillness. You need to hold cash when greed roars, hold great companies when fear screams, and hold your nerve when the world demands you act now. Most will never do this. That's why decades from now, Buffett's strategy will still beat yours, unless you choose, starting today, to live what he's quietly taught all along. If you stayed with me until now, you're already ahead of Mike. Before this video fades, pick one habit to cut, one useless scroll, one impulse buy, one rushed trade, and redirect that time or money to something that compounds quietly in the background. It won't feel heroic at first. But one day, when everyone else is panicking again, you'll realize you don't need an oracle. You just needed the patience to become your own. Most people will close this window and drift back into the same habits that keep them broke, stressed, and forever chasing what they think someone smarter must know. But you're not most people. Not anymore. You've just seen how the simplest principles, stubbornly protected, can outperform the loudest trends and the cleverest tricks. Don't let this be another piece of forgotten advice buried under tomorrow's notifications. Do one small thing today that your future self will thank you for. Automate a bit more savings, study one company properly instead of 10 rumors, or just pause before your next impulse trade. If you know someone who's stuck hustling for pennies when they could be building quiet wealth, share this with them before they waste another year. The next Buffett won't be the loudest in the room. They'll be the one quietly compounding while the crowd stays busy. Stay patient, stay boring, stay wealthy.